In this lecture, we will explore hedging and financial risk management across foreign exchange rates, interest rates, and commodity prices. Every firm faces uncertainty. Exchange rates move, borrowing costs change, and input prices rise or fall. These movements can affect cash flow, liquidity, profit margins, financing capacity, investment plans, and ultimately firm value. A hedge is a position or business arrangement designed to reduce exposure to one of these risks. It may involve a derivative contract, such as a forward, futures contract, option, or swap. It may also involve an operating decision, such as matching revenues and costs in the same currency, changing sourcing arrangements, or using long-term supply agreements. Firms hedge to improve cash flow stability, protect liquidity, support investment, manage debt obligations, strengthen budgeting, and give stakeholders more confidence in financial plans. But the goal is not to eliminate every risk. The real question is, which risks is the firm paid to bear, and which risks are merely distracting the firm from its core business? Good risk management separates value-creating business risk from incidental financial risk. Let's begin with an essential distinction: hedging versus speculation. The same financial instrument can be used for either purpose. What matters is not the instrument itself, but its relationship to the firm's underlying exposure. A position is a hedge when it reduces an existing or highly probable risk. It is speculation when it creates a new exposure, increases risk, or moves the firm farther away from its approved risk target. This is why every derivative position should be viewed together with the underlying business exposure. A loss on a hedge does not automatically mean the hedge failed. The underlying exposure may have gained value by a similar amount. In the same way, a gain on a hedge may simply offset a loss in the business. The correct question is not, did the derivative make money? The correct question is, did the combined position behave as intended? A sound risk management program also begins with objectives, not products. Management must decide what it is trying to protect: cash flow, margins, liquidity, earnings stability, debt service capacity, financing plans, project value, or protection against financial distress. Once the objective is clear, the choice of instrument becomes much more disciplined. A disciplined risk management process follows a logical sequence. It begins by identifying exposures. Management asks which cash flows, assets, liabilities, margins, or investment returns are sensitive to market prices. Next, the firm measures each exposure. This includes its expected size, timing, currency, interest rate index, commodity benchmark, and degree of uncertainty. Then, the firm sets risk limits. These limits define how much volatility, liquidity pressure, or potential loss the organization is willing and able to retain. Only after that should management select tools. The solution may involve derivatives, natural hedges, contract terms, financing choices, or operating adjustments. Execution is not the end of the process. The firm must monitor hedge performance, forecast changes, counterparty exposure, collateral needs, rollover risk, and basis risk. It must also report results clearly and maintain proper authorization and documentation. The target is rarely zero risk. Eliminating all exposure may be impossible, too expensive, or strategically unwise. The key concept is risk capacity. A highly leveraged firm with tight liquidity and major investment commitments may need more protection. A firm with strong cash reserves, flexible operations, and healthy margins may be able to retain more uncertainty. Risk tolerance is a preference. Risk capacity is the financial ability to absorb adverse outcomes. Let's now review the main hedging instruments. A forward contract is a customized agreement to buy or sell an asset, currency, or rate at a future date under terms agreed today. It is useful when the exposure amount and timing are known. The advantage is certainty. The trade-off is that favorable market movements are usually given up. A futures contract also locks in a future price, but it is standardized and traded through an exchange. Futures are generally liquid and transparent. However, daily settlement can create margin cash flow needs, and standardized terms may not perfectly match the exposure. An option gives the holder a right but not an obligation to buy or sell at a specified price. Options protect against unfavorable movements while preserving favorable outcomes. That flexibility has a cost, paid through an upfront or embedded premium. A swap is an agreement to exchange cash flow streams over time. Swaps can transform floating rate payments into fixed payments into floating payments, one currency into another, or a floating commodity price into a fixed price. The best instrument depends on the exposure. Known commitments often fit forwards. Uncertain or contingent exposures often fit options. Repeated or long-term exposures may fit swaps, caps, collars, or layered hedging programs. The instrument should serve the exposure, not define it. Let's look more closely at forwards and futures. A firm expecting to receive foreign currency can sell that currency forward. This creates certainty about the home currency proceeds. A firm expecting to make a foreign currency payment can buy the currency forward, creating certainty about the home currency cost. The protection is straightforward, but so is the trade-off. If the market later moves in the firm's favor, the forward prevents the firm from receiving that benefit. Forwards work best when the amount and settlement date are reasonably certain. When the forecasted transaction is uncertain, a forward can leave the firm with an unwanted derivative position if the underlying exposure does not occur. Futures contracts provide similar price protection, but their structure is different. They are standardized, exchange-traded, and settled through daily marking to market. A clearinghouse reduces counterparty credit risk, yet daily gains and losses can create short-term liquidity pressure through margin calls. Futures may also create basis risk. The contract's delivery date, location, quality, grade, currency, or index may differ from the firm's actual exposure. A futures hedge is most effective when the price relevant to the firm and the futures price move closely together. A hedge can be economically sound over its full life and still require significant cash along the way. Options provide a different kind of protection. A call option gives the right to buy. A put option gives the right to sell. Because the holder can choose whether to exercise the option, the position offers flexibility that a forward does not. A firm with a foreign currency payable may use a call option to place a ceiling on its currency cost, while still benefiting if the currency becomes cheaper. A firm with a foreign currency receivable may use a put option to place a floor under the value of its proceeds, while still benefiting from a favorable exchange rate movement. The cost of this flexibility is the option premium. Options can also be combined. A caller buys protection on one side and sells away part of the favorable outcome on the other side. This can reduce the premium, but it narrows the range of possible benefits. Swaps are especially useful for repeated, long-term, or financing-related exposures. An interest rate swap can convert floating rate debt into fixed rate debt, or fixed rate debt into floating rate debt. A currency swap exchanges cash flows in different currencies. A commodity swap exchanges a floating commodity price for a fixed price, or the reverse. Swaps allow financing and risk management to be separated, but they also introduce counterparty risk, collateral requirements, valuation complexity, and a need for strong policy controls. The quality of a hedge depends on how well it matches the exposure. Management must compare the hedge with the underlying risk in terms of amount, timing, currency, interest rate index, location, commodity grade, delivery terms, and settlement method. A mismatch leaves residual risk. Known commitments may be suited to fixed price contracts or forwards. Uncertain commitments may be better suited to options or flexible operating arrangements. Recurring exposures may be managed through rolling or layered hedges. Long-term financing exposures may require swaps, caps, floors, or collars. Layered hedging recognizes that near-term forecasts are usually more reliable than distant forecasts. A firm may protect more of its expected exposure in the near term and less of it farther into the future. This reduces the danger of hedging transactions that may never occur. The firm should also hedge net exposure rather than blindly hedging every gross inflow and outflow. Overhedging can turn risk management into speculation. Natural hedges deserve special attention. A firm may match foreign currency revenues with costs in the same currency, finance a foreign project in its operating currency, diversify suppliers, adjust pricing clauses, or locate production near its sales market. Natural hedges are not free. They may increase financing costs or reduce operating efficiency. Their advantage is that they reduce risk at its source and may be more durable than repeated short-term derivatives. Foreign exchange risk begins with a simple question. Is the firm economically long or short the foreign currency? A foreign currency receivable creates a long position. The firm benefits when that currency strengthens because the receivable converts into more home currency. A foreign currency payable creates a short position. The firm is harmed when the foreign currency strengthens because the payment becomes more expensive in home currency terms. The relevant exposure is usually the net position after foreign currency inflows and outflows are combined. Hedging only one side while ignoring offsetting cash flows can create an excessive hedge. Several tools are available. A forward locks in a future exchange rate. An option provides protection while preserving favorable currency movements. A money market hedge uses borrowing and lending in different currencies to create a synthetic locked-in rate. A currency swap exchanges principal and interest cash flows across currencies. A natural hedge matches currency inflows with currency outflows, assets, liabilities, or financing. The firm must also distinguish confirmed transactions from forecasted transactions. Confirmed exposures are easier to hedge precisely. Forecasted exposures require more flexibility because the amount or timing may change. Most importantly, foreign exchange hedging should be connected to a commercial exposure. The objective is not to win a currency forecast. The objective is to protect the economics of the business transaction. Interest rate risk affects cash flows, asset values, liability values, and investment decisions. Floating rate debt creates direct cash flow exposure because interest expense changes with the reference rate. Fixed rate debt creates more predictable cash interest payments, but its market value changes when market yields move. Duration helps managers understand how sensitive a fixed income value is to changes in yield. The appropriate hedge depends on the concern. A firm focused on future cash interest payments may use a pay fixed, receive floating swap. A borrower seeking protection only against unusually high rates may prefer a cap, which preserves the benefit of lower rates. A lender or investor may use a floor to protect against unusually low rates. A borrower can combine a purchased cap with a sold floor in a collar, reducing protection cost while giving up some benefit from very low rates. Commodity and input price risk works through operating margins. Raw materials, energy, transportation, packaging, and supplier pass-through charges can all create exposure. Firms may use futures, forwards, commodity swaps, options, long-term supply agreements, inventory policy, pricing clauses, and operational flexibility. They may diversify suppliers, substitute inputs, redesign production, or shift production locations. The exposure may be financial and strategic at the same time. A price increase matters less when costs can be passed to customers quickly. It matters more when selling prices are fixed, competitors have different cost structures, or supply alternatives are limited. We now come to basis risk, hedge ratios, governance, and the broader managerial lesson. Basis risk is the possibility that the hedge and the underlying exposure do not move together perfectly. Differences in timing, location, quality, index definition, delivery terms, or settlements can leave residual risk. A hedge does not need to be perfect. It must reduce risk enough to justify its cost, complexity, and liquidity demands. The hedge ratio describes the size of the hedge relative to the exposure. Full coverage may suit a highly certain exposure. A smaller hedge may suit an uncertain forecast or an imperfect benchmark. Correlation, relative volatility, contract size, and business judgment all matter. Hedging also uses credit capacity, collateral, cash, time, and managerial attention. Strong governance is therefore essential. Policy should define objectives, approved exposures and instruments, limits, authorization, segregation of duties, documentation, counterparty controls, valuation, reporting, and collateral planning. An integrated program may combine currency, interest rate, and input price protection. It should be judged as one coordinated portfolio together with the underlying business. The best program does not eliminate uncertainty. It makes uncertainty manageable, protects strategic flexibility, and allows the firm to focus on the risks it is truly paid to bear. Thank you for joining me today. I'll see you in the next video.